insurance companies currently use CSA scores to evaluate a motor carrier's risk?
Well, most insurance companies take the CSA basic scores and use them as a initial indicator of that risk to determine, the value they're going to place on the insurance program. As few as 18 months ago, insurance companies would look at motor carriers with 2 or 3 basics and alerts, and as long as the loss experience was good and they had good controls in place, we could place that risk, with one of the primary markets. Today, motor carriers with 3 alerts and average loss experience is going to have a very difficult time finding insurance.
What have been some key concerns from motor carriers over the past year or two when it comes to the CSA basic alerts?
Well, for the motor carrier, I refer to me as part of the industry, the motor carrier industry. We haven't seen it as equitable or fair across the board. You've got state and local biases, meaning that certain states, there's a top 10 list out there, but states like New York, Georgia, Florida, state of Texas, Idaho, not picking on those states, there's a top 10 list. Those states write more violations per inspection than the rest of the country. So if you operate in any of those states, you wind up with a higher score. So that has nothing to do with your operation. It has everything to do with the state and how that state enforces the rules or the law. So that's one issue. Second, another big issue is peer grouping. So we call them safety event groups within CSA, and meaning motor carriers of like size. Well, in this case, it's like number of inspections. And that is irregardless of the type of operation you are. So it's a bias based off of your, again, the state and the type of operation you are. It's not really equitable that a flatbed carrier is compared to a tank operation, it's compared to a package delivery company, it's compared to a drive-in company. So it's not really the same peer group. One of the other big things that I see is the data queue process. The data queue process seems to be very lacking in how it's dealt with. You wind up in data queue, for those of you that don't know, it's the appeal process within CSA where you get a violation, you disagree, it's how you appeal that violation. That violation is typically reviewed by the officer that cited you. So it's sent back to the same officer. He or she is then asked to review their citation and make a decision to overturn it. And there's very little appeal to that. All you can do is continue to send it to that same officer. Occasionally, some states will allow a supervisor to look at it.
But just backing up a little bit, Bert, so with these basic alerts, that's making it even harder for them to get, or it's making premiums skyrocket. Could you just back up and elaborate on that point a little bit? What does it mean for motor carriers looking to buy commercial auto liability insurance?
Today, we've been going on for CSA for now nearly 8 years across the country. So now there's evidence, when you talk to the insurance market, there's evidence that having certain basics and alerts, you'll pay higher claims. So the ones I hear cited most often are going to be unsafe driving, if you're an alert there, you're an alert in hours of service, or you're an alert in vehicle maintenance. Typically, insurance companies pay higher claims for those basics being an alert.
What are some tips for motor carriers and fleets looking to lower their insurance premiums and related costs in light of everything that we just discussed, and until some certainty, however long this will take, in the revamp of the CSA program?
Well, just managing your overall cost, we call it cost of risk. So that's your premium dollar plus the money you spend on your accidents, crashes, within the deductible, things you pay out of pocket. Just managing that overall cost with, a better program, better processes, better controls, telematics, managing CSA. Those things will help you lower those costs. I would tell you today, though, in a hard market, we refer to a hard market, and what I mean by a hard market, that means insurance rates are going up. In a hard market, even doing those things, you're going to struggle to get lower insurance rates. So obviously the next step in that is to take on more risk, meaning you're going to own more of that that claim. You have higher deductibles or higher retention. And just by the virtue of having higher retentions means you're going to pay more of that loss. So, again, you've got to get better at managing the claim, better at reducing that claim, be it telematics, better programs, better controls, better processes. There's captives out there. Captives can get you into a place with lower premiums, if you will. I just would caution anyone going into a captive to think long and hard about it, make sure it's calculated. Once you're in a captive, it's very difficult to get out of a captive because you've got a lot of collateral tied up. It's a long play. It's truly an extended play. Jumping out of a captive is not as easy as getting in one. The other thing captives have, if you're not careful, they have hidden management fees, hidden actuarial fees, and you got to remember it's a shared risk program, meaning you are in a program with other motor carriers, so if they have bad experience, that reflects on your pricing or your pocketbook also.
To elaborate a little bit more, like what size fleets are you seeing, small, medium, large? Who would that be the ideal to really get into a captive? And if you can briefly explain in very simple terms what a captive is?
Yeah, so a captive is, I would call it shared loss. So meaning if I have a trucking company, you have a trucking company, we find the typical marketplace out there is we can't afford the insurance rates. They're just too high. So me and you would get together and we would have leverage our economy of scale. We would bring more trucks or more risk to the marketplace, and then we would share in that risk. So we would combine our premium dollar. We would take a higher deductible. We would pay that deductible out of pocket or out of the premiums you would pay into that captive. In theory, at the end of that, if we've controlled our losses better, then we get a dividend payback, meaning we pay more in premium than we pay out in dollars, so we get a dividend paid back to us. Occasionally, captives become kind of a catchy thing, kind of the new thing. It's just something to proceed with caution. It's not always the wrong move, but it's not always the right move.
Another broker that I've spoken to has said that they're seeing it, at least more of a trend, go that way in recent years, at least with this company. Is it a certain size of motor fleet is my question. Yeah.
Yeah, if I had to guess, I mean, it's not, where I see it makes sense, I'm not guessing, but where it makes sense, it's going to make sense for the motor carrier. It's in that 100, 200, 250 to 500. You get over 500, I believe, in my experience, you can manage your risk with a high deductible or what we call a high retention product, just meaning you'll take $100,000, $150,000, $200,000 of your risk. We can take that dollar, invest in your company, you become a more profitable, just a better overall, more efficient company, plus you're controlling your loss and you're able to buy insurance at a higher, a higher contact. So, I mean, you're buying in at $250,000 or $250,000, so you're not paying as much premium. You're reinvesting that dollar within the company. When you're over 500 trucks, 500 above, you need to be in a high retention program and managing those costs under that high retention yourself. No one's going to spend your money like you are. So you can pass it off to captive. Captives still have to have management teams, so you have to have a TPA to manage your claims. You have to have someone manage the money in the captive. Still, no one will ever manage your money like you.